Okay, so what is an hedged ETF? That is a question that many people have, and today we're going to answer that with some examples. So let's get down and let's check out what a hedged ETF really is. Okay, so a perfect example of this is ZSP and ZUE. They are both the exact same thing. However, ZUE is hedged. What does hedged mean? Well, let's read the portfolio strategy and try to figure this out. So, the BMO S&P 500 hedged to Canadian index ETF has been designed to replicate to the extent possible the performance of the S&P 500 and hedged to Canadian dollars. The ETF invests in and holds the constituent securities of the index in the same proportion as they are reflected in the index itself. The US dollar currency exposure is hedged back to Canadian dollars. In addition, as ZUE is a fund of fund, the management fees charged are reduced by those accrued in the underlying funds. So when we look at the holdings of ZUE, it's actually just ZSP, which is the unhedged ETF of the exact same thing. However, a larger portion is held in technically negative cash. What does that mean? What does that really mean altogether? Well, basically, when it comes to a hedged ETF, it's hedging your bet against the currency. So, for example, if our currency in Canada goes up by, let's say, 10% and the American currency goes down by 10% altogether, however, the stock market itself in the States goes up 10%, well, guess what? We missed out on that 10% gain, and it's net zero. It didn't actually happen. However, if our currency goes up and the stock market goes up, let's say by 10%, we're hedged to our dollar, which means that we actually get that 10%, or at least something close to it. That's the idea behind a hedge. However, a hedged ETF can also work against you as well. Let me explain. Okay, so this can get a bit confusing. So, altogether, if you invest $100, and let's say your currency on this side is going to be a 10% change either way, and then the market itself is going to be a 10% change either way. And then we've got hedged versus non-hedged. If the currency goes up by 10% and the market goes up by 10%, you're going to see a benefit on the non-hedged side, while the hedged side is only going to be up 10%. Meanwhile, if you're seeing an increase of 10% on currency and a decrease on market, when it comes to the hedged, it's going to be a negative 10% and roughly 0 on the non-hedged side. If, for example, you go down by 10% on currency and up 10% on market, that would then give the non-hedged roughly 0, and then hedged would be a plus 10%. However, if both go down, currency as well as market, and this would be host currency, then you would have a 20% plus decrease on non-hedged and a negative 10% percentage on the hedged side. So altogether, you are going to have less risk when it comes to the hedged side, because when it comes to the hedged side, you're going to be down 10% and you're going to be down 10% max. You are then going to be positive 10%, 50%, or at least a 50% chance of being positive 10% and a 50% chance of being positive or negative 10%, either way. Meanwhile, if you're in a non-hedged, you have a greater chance of either not gaining anything or losing 20+%. You only have a smaller chance of having a greater positive. So if you personally think that your country's currency is being devaluated, which means the host currency goes up, and if you think the market's going to be going up, then having a non-hedged is a better choice. However, if you think that the market's going to be doing one of these three other options, then hedged would be the better choice. Overall, you could go either way. Currency doesn't usually change by 10+%. It's not usually going to happen. If you're investing in a country like maybe China or a developing country, you would definitely want to have a hedge on currency because their currencies move almost very similar to Bitcoin, where it's just so much fluctuation that it's hard to keep track. However, if you're looking at Canada versus US, you could go either way because there's not going to be massive fluctuations in currency. You're usually going to see maybe a 1 or 2% change over the year. So you would then have a greater chance of potentially making more money, especially if Canada goes into a recession, for example, and the United States flourishes. That's the only time that you would really want to see a non-hedged ETF. Now, I'm not saying which way to invest. This is just an example of what could happen. I hope that this really does explain it. If it does, hit that like button and subscribe, and I'll see you guys again next time.